We've just finished talking about, in the last video, non-strategic investments, or passive. Now we're going to talk about strategic equity investments. Remember, it's equity we're buying, shares and things like that. So, do you remember what the percentage was for strategic equity investments, where we use the equity method? It was generally 20 to 50% ownership. So when you hold it in another company in order to influence the company but not control it, that's called having significant influence over the associate. So for example, if you owned, I'm drawing a blank, I'm looking outside going, well, what do you own? Oh, you build houses, you're a construction company, and you're a large construction company, and you own a shingle company. You could buy up to 50% of a shingle company and intend to, because you own so many shares, you have control over some of the decisions they make. So that's one reason you'd buy it. And there's other reasons in the textbook and stuff, you can look at that. So according to IASB, significant influence is having the power to participate in the financial and operating policy decisions of an entity, but not having control. So you're not over 50%. Note that the investor does not actually have to exercise the power to influence. So they could control the board of directors, but they don't have to. So in general, the percentage of ownership between 20 to 50, but it also involves several qualitative factors that can affect the level of control. So following conditions are potential indicators that significant influence is present. So representation on the board of directors, participation in the policy-making process, material transactions between you and what you're invested in, interchange of management personnel, or provision of essential technical information. So each of the specific circumstances will determine whether or not significant influence exists, and in reality, substantial professional judgment is required in making the decision of investment classification. For example, let's say we owned 18% of ABC. Okay? All the other shares were spread out over, just say a lot of people. Okay? So no one's share was close to ours. So it's likely with this much share power concentrated, even though we're not 20%, we might have representation on the board of directors because everything else is spread out. Everybody else has ownership. We might be able to participate in the policy-making process. Remember, we don't have to, but we can. We might have interchange of management personnel, could have material transactions. We could have given them essential technical information. So if any of those held true, likely we would treat this, because even though it's only 18%, as a strategic investment. Does that make sense? If we're the only ones that have any type of control and everybody else only has one share, well, when it comes to voting things, we'll be able to get much more power on the board. Okay? On the other hand, let's say we owned 40%. And all the other 60% were owned by one other company. We definitely don't have control, and it's not sure if we actually have an influence here, because one other player can make the actual decisions they control. So this 20 to 50 isn't carved in stone. It just, depending on circumstances. Now, IFRS entries of this type of investment are done using the equity method, which you may or may not have learned in 315. ASPE allows a choice between cost or equity method as long as you apply it consistently across all investments. Makes sense. Now, this is kind of interesting because what happens? Think back to the fair value method. If the investment goes up, we increase the investment, right? And we record a gain. If it goes down, we decrease and there's a loss. It's either in net income or OCI, okay? When the other company earns net income, do we record anything? No, why would we? It's another company, okay? Now, obviously, if they give us dividends, we record our share, okay? So, with this, it's like, because we have significant influence over it, so we could influence what it does, influence who it sells to, influence what it's selling, all that kind of thing. Pricing, definitely, especially if we're selling between each other. So with the equity method, you treat it like it's sort of attached to you, okay? So it's part of you. So here's us, or you, and here's our little strategic investment. Okay? So when they do well, we own so much of it and have such, it could have such a risk on us that we treat it like we're attached. So when they earn net income, it's good for us, right? But if they give a little piece of themselves away, is that good for us? No, because they're linked to us. Their performance affects us. So, net income, when they declare net income, actually increase the investment. But when they declare dividends, we're reducing the value of the company. Now, be careful with this word value, you guys. I'm not talking actual dollar. It's just they don't have as much cash or whatever anymore. They've reduced their balance sheet, okay? We actually decrease the investment. And when it comes to fair value at year end, we don't care. So it's a little strange to what we've been doing. So, with the equity method, investment is reduced when dividends are distributed. So here's our little associate here. Hope you can read that. It says associate. And when they declare dividends, we reduce the value, our little T account, of their investment. But if they declare net income, that's good for us, so we increase the investment and record a gain. Fair value, unlike the fair value methods, we don't care about. Okay? So, let's go through this in sense. Okay, first of all, we're going to start with this text, assuming IFRS, unless it says otherwise. Okay, so let's start reading through our question, our example. Remember, this is the equity method. January 1st, year 1, Genstar, that's us, purchased 30% of the outstanding common shares of SafeBuy for $95,000 cash. So, similar question to the one we did for the fair value. We've just different weightings on what we bought. So 30%, what do you think? Is it a passive investment, significant? Do we have control? What is it? It's strategic. So because it's IFRS, we use equity method. If it was ASPE, you could have used either equity method or just cost. So just remember, if they're looking for ASPE, they won't tell you to use cost. They have to tell you. They can't assume. Sorry, I'm just getting some gum. Okay. So let's do the entries. So Genstar purchases, oh my goodness, purchases standing common shares, 30% of them of SafeBuy. So what's the entry? You guys know this already. What did we give away? Cash. And we gave away $95,000. Now the question is, what did we get? Did we get common shares? Yeah. So put common shares here? No, because whose common shares are they? Someone else's common shares. Can't have two kinds of common shares. So what do we put? Investment. And you can put in associate or in a strategic investment. You can do whatever you want. Okay, but not common shares. The only time we use common shares is our own. Okay, and just to review, investment is what kind of an account? An asset. Okay, questions? Okay, let's go on to page 6 and continue this. So it's now December 31st, year end. And the fair value of the 30% interest was $98,000. SafeBuy reported net income of $100,000, reported OCI gains of $10,000, and paid dividends of $80,000 for the year. So let's start at the end. What did we get? And remember, this is the equity method. Okay, what did we get? We got dividends. And the order you do these in doesn't matter. So we got cash. Be careful, sometimes it's AR. Or dividends receivable. If it said declared, then it would be dividends receivable. Now, did we get all 80,000? No. We only got 24,000 because that's 80,000 times what we own. Now, this is the equity method. We own a big enough chunk that they really influence us. We can influence them, so we're kind of related. So, they just gave away cash. Sure, it was to us, but we're recording their investment, our investment in them right now. So they just gave away cash. Is that good, generally? Now, of course, yes, it is good if you've been giving dividends for years and you are able to keep that up and everything. Yes, that's great. But overall, if you just look at that circle of a business, what happened to its cash? It went down. Okay? So that means our investment in them goes down by $24,000. So even though we got cash, by them giving their cash away, their investment actually went down in our relationship of being attached to each other. Okay, now, I'm used to, in this chapter, writing fair value. Do we use fair value in the equity method? No. But is there something else we're going to use in the equity method? I thought there were two things. Yeah, net income. So we are going to record net income, and we're going to record OCI. And you record it separately because generally we try and keep the net income parts and OCI part just like we have in other chapters. So we need to record our portion, even though we haven't received it. So we said on the last page we're going to make the investment go up. Our portion, so 100,000 times 0.3 is 30,000. Now we are going to record income or revenue, and we're going to call it equity method income, and that's also 30,000. Now we need to record our little OCI. So was it a gain or a loss? It was a gain. So record OCI. So we are going to debit investment. And why is it going up? Because they recorded a good thing, an OCI gain. If it was a loss, it would reverse. This time it's 10,000 times 0.3, which is 3,000. And again, credit equity method income, but we're going to add OCI on it. So make sure you put that, and you'll be good. Now, you could combine these entries. Combining those, and this, and this. Okay, so that's an example of the equity method. Just remember, it's like they're attached to you. So if something good happens to them, it's like something good happens to you, like you get net income. And if they give away their cash, even though it's to you, for their investment, it makes it go down. The investment go down, and we do not record fair value. So next we're going to do changes to and from the equity method.